Hello and welcome to FinanceWalk. Today we are going to see investment horizon. As an equity research analyst, you must know different avenues available in market. In this chapter, we'll cover overview, a broad map of the territory, that is a broad view of different investment alternatives, and next, yes, definitely investment alternatives. Investment attributes, different features of different investment alternatives. Investment avenues comparison, how do these investment avenues compare? And qualities required for successful investing. So you will check which are the different qualities required for a successful investor. Financial instruments, different financial instruments in capital market. Stock market classification of equity shares. As an equity research analyst, you must know different equity shares available in stock market and their names basically. So we'll see some jargons, or I would say some names given to these shares. What are bulk and block deals? And this is part of trading terminology. Arbitrage opportunities. What are arbitrage opportunities and how do you spot them? Insider trading. What is insider trading and what qualifies as insider trading? Now let's see an overview or a broad map of this territory, that is investment. Okay, in this broad map of the territory, we'll check investment alternatives, investment attributes, how do various investment avenues compare, and qualities for successful investing. Investment alternatives. Okay, there are two kinds of financial assets. One is marketable and the second is non-marketable. Marketable assets or marketable financial assets, we can see examples like equity shares, money market instruments, third is bonds, and fourth is mutual funds. So these are marketable financial assets. This can be marketable and they have market available anytime if you want to sell or buy these assets. We'll check now non-marketable financial assets. Non-marketable financial assets are first bank deposits, second is post office saving deposit, third is company deposits, fourth is provident fund deposits. These assets are not marketable. That means these assets do not have a market, and you definitely cannot buy and sell these assets in any market. Of course, life insurance is a part of this non-marketable financial asset. Now we'll see investment attributes, different investment features. For evaluation purpose, we should look at the following attributes. Okay. First is rate of return. Rate of return, that is the returns in percentage terms on your investments. Risk. What is risk? Risk is potential negative impact to an asset. Third feature or third attribute of investment is liquidity and marketability. What is liquidity and marketability? It is the ability and availability of assets to be readily converted into cash. So the investment attribute, that means it should have market, and it should be liquid. That means anytime the asset should be or can be converted in cash. Fourth attribute is convenience. Convenience is the ease with which the investment can be made and looked after. So that I would say the convenience factor is one of the most important investment attributes. Now, how do various investment avenues compare? Let's see the comparison table. On left hand side, you will see different investment alternatives, that is equity shares, non-convertible debentures, and different equity schemes. Top row, you will see return, that is current yield, capital appreciation, risk, marketability or liquidity, tax shelter, and convenience. Look at equity shares. Equity share has a low yield, current yield, capital appreciation high. Yes, since it's equity, you will definitely gain capital appreciation. Risk is quite high. Of course, marketability and liquidity is fairly high, tax shelter high, and convenience high. Yes, non-convertible debentures, current yield is high, capital appreciation is negligible, risk is low, marketability is average, tax shelter nil, convenience again is highly convenient. Equity schemes, low current yield, high capital appreciation, high risk, high marketability, high tax shelter, and convenience is very high. So if you check equity shares and equity schemes, they have fairly many points in common, right? There are other investment avenues also. They are PPF, that is PPF, then life insurance policies, residential house, gold and silver. So PPF, current yield is nil, of course, capital appreciation is moderate, risk is nil, marketability is average, tax shelter, that is section 80C benefit you will get, convenience is very high. Life insurance policies, yes, definitely life insurance policies. If you see life insurance policies and PPF, all things are common, all things are same, that is current yield, capital appreciation, risk, marketability, tax shelter, and convenience. They are the same. A residential house, current yield is moderate, capital appreciation moderate, risk is negligible. Why risk is negligible? Because that's real asset, right? Marketability or liquidity low, tax shelter is high, convenience is fairly convenient. Gold and silver, current yield nil, capital appreciation moderate, risk is average, marketability is average, tax shelter is nil, and convenience is average. So if you check capital appreciation wise, let's visit the earlier slide once again. Equity shares and equity schemes, capital appreciation is highest amongst all investment avenues, and due to this feature, most of us are interested in equity schemes, right? So as an equity research analyst, you need to know these different investment alternatives and why equity is popular amongst all. Okay, now once we have seen this investment avenues, let's move to different qualities required for successful investing. Now, if you consider yourself as a successful investor, check whether you have these skills or qualities. Okay, the game of investment, as any other game, requires certain qualities and virtues on the part of the investors to be successful in the long run. So mind well, we are talking here about long-term success and investment. So what are these qualities? Let's check. Contrary thinking. Now, what is contrary thinking? Thinking on your own and avoiding the temptation of going with the crowd. Many times you see in the market that there is panic and there is greed in market. So most analysts say due to greed and fear, the market moves up and down. There is slight change in price movement, or if there is a news which is not that relevant, or I would say significant, but at the same time there is a crowd mentality which moves the Sensex up and down. So contrary thinking is important. Second is patience. Staying for longer period gives you excellent returns as against short-term gains. That's rightly said. Patience. You need to have patience in stock market. If you do not have patience, try some other investment alternatives like fixed deposit, LIC or PPF. But if you want long-term gains and capital appreciation, you need to wait for good returns. I would say at least 3 to 5 years. That's required. That's important for long-term returns and good capital appreciation. Third is composure. Rely more on hard numbers and less on judgment. So you need to focus on research and analysis of the financials, business fundamentals, more and less on judgment. That means less on tips what other people are giving. So do your own analysis. Fourth quality of successful investor is flexibility and openness. Keep in mind that nothing is permanent except change. So you have to be flexible and open to accept new ideas. If you have many ideas, only then you can select one of them. But if you have only one idea, that's dangerous. So you more rely on that only idea, the single idea, and you actually do not look at other ideas. So that's quite risky. So have flexible and open mind. Fifth quality is decisiveness. So what is decisiveness? Not reaching conclusions on the basis of inadequate premises. So as we have mentioned in composure point, rely more on data analysis, research, and your own judgment than inadequate information, then relying more on some other people's tips. That's quite dangerous. So these are qualities required for successful investing, so keep in mind. After this, we'll move to financial instruments. What are different financial instruments in different markets? As an equity research analyst, you need to know different financial instruments, because in your research and analysis you will deal with them. Money market, treasury bills, certificate of deposits, they are called CDs, commercial papers, repos and reverse repos. Second, in bond market, government securities and corporate bonds. And in equity market, of course, common stock, that is shares, and preferred stock, that is preferential shares, right? Fourth is derivative market, that is options and futures. So let's stick to our study, that is equity market, and let's see stock market classification of equity shares. So this classification is important for you, because you will be using these keywords. What are these keywords? First is blue chip shares. Blue chip shares are of large, well-established and financially strong companies with an impressive record of earnings and dividends. I repeat, shares of large, well-established and financially strong companies with an impressive record of earnings and dividends. So the companies like Reliance, Infosys, Tata Steel, Tata Motors, they qualify for this category or classification, right? Second is growth shares. What are growth shares? Shares of companies that have a fairly well-established position in a growing market and which enjoy an above average rate of growth as well as profitability. So think of these growth shares, and you can write to me in comment section once you find these growth shares. Okay, income shares. Third classification is income shares. Shares of companies that have fairly stable operations, relatively limited growth opportunities and high dividend payout ratios. Look at these companies. These companies have a very good trend or history, I would say, and they have fairly stable operations. The market is stable and quite matured companies. You can look at relatively limited growth opportunities and high dividend payout ratio. Why do they give high dividend? Because of course what they earn, they do not have to invest in the business again for different investment projects. So the amount of cash they have, they distribute amongst shareholders. So they have high dividend payout ratios. Next is cyclical shares. Cyclical shares. So the shares of companies that have a definite cyclicality in their operations. So look at these companies, think of cyclical shares and write to me in the comment section what do you think about cyclical shares. Defensive shares. Now what are defensive shares? Defensive shares, shares of companies that are relatively unaffected by the ups and downs in general business conditions. Look at pharmaceutical companies or FMCG companies. You know, whether the overall business cycles or let's say general business conditions, they move up or down, you are going to brush your teeth, right? You are going to go to the doctor and buy medicines. Now whether there is an earthquake or there is tsunami, you are going to do these things. You are going to bath, so you need soap. At the same time you need other medicines. So pharmaceutical industry, FMCG industry shares, they come under this classification. Next is speculative shares. What are speculative shares? Shares that tend to fluctuate widely because there is a lot of speculation trading in them. So you will see speculative shares. You will see some unusual up or down trend in volume and price. So spot that first and then you can see those shares are speculative shares. The shares which are not supported by the business analysis of that company or any reason of any change in financial condition of that company is if that particular share is moving up and down due to high volume or low volume, then you can see that share is a speculative share. Alright, now let's move to bulk and block deals. Now what are bulk deals and what are block deals? Here there are two lists. First list is of bulk deals. Left hand side you will see the list. These are bulk deals. On right hand side you will see block deals. Now let's see the definition or the concept of bulk deals first. The concept says member broker has to make a disclosure on daily basis up to 5 p.m. through DUS, that is data upload software, with respect to all transaction in a script for a client where total quantity bought or sold is more than 0.5% of number of equity shares of the company listed on the exchange. Now that's about bulk deals. What are bulk deals? Member broker has to make a disclosure on daily basis through data upload software, that is DUS, with respect to all deals that have been executed by them on behalf of their client or own account in block deal window. A trade with a minimum quantity of 5 lakh shares or minimum value of rupees 5 crores executed through a single transaction on this window will be qualified as block deal. Let me repeat. A trade with a minimum quantity of 5 lakh shares or minimum value of rupees 5 crores executed through a single transaction on this window will be qualified as block deal. And member broker has to make a disclosure on daily basis through data upload software. Okay, bulk deals are the one in which someone buys or sells the shares directly in the market from one or many buyers or sellers. You can see a bulk order placed in the order queue in the order book of the particular script. Whereas in a block deal, the trade happens between two agreed parties. It happens when one party would like to buy or sell to other party at an agreed price between them. You cannot see this kind of orders placed in the order book, right? Because it is not supposed to be visible to the general market before trade, but is informed to the exchange after that. Okay, this is about bulk and block deals. You can check more about bulk and block deals on BSC website. Now, arbitrage opportunities. What is arbitrage opportunities? Stock price difference between BSE and NSE at the end of the day. So here left hand side you will see different companies, NSE close, then next column says BSE close price, difference in rupees and percentage difference. So what is arbitrage? So you buy the particular script at one exchange and you sell the same script at on second or different next exchange. Here the exchanges in question are NSE and BSE. Look at the first company, that is Bill Energy. NSE close is rupees 100.95 and BSE close is rupees 92. Difference is in rupees is 8.95 and percentage difference is 9.73. So there are different companies like Hira Ferro, Kalyani Forge, Filatex India and other companies. So if you want to take the arbitrage opportunity, you need to simultaneously buy and sell on different exchanges, right? So after completing this arbitrage opportunities, let's move to insider trading. Now, what is insider trading as a concept? Okay, insider trading is buying or selling in a particular script by an insider who is in possession of material, non-public, price-sensitive information or the tipping of such information where tipper breaches a fiduciary duty or trust arising out of a trust of confidence. The taste of insider trading is that this information should be used for personal gain and to the detriment of the investing public. So you understand insider trading. I repeat, insider trading is buying or selling in a particular script by an insider who is in possession of material, non-public, price-sensitive information or the tipping of such information where a tipper breaches a fiduciary duty or trust arising out of a trust or confidence. The taste of insider trading is that this information should be used for personal gain and to the detriment of the investing public. So you understand, insider trading is not really good and it's not in interest of general public. Right, so what are price sensitive information? Let's see examples of price sensitive information. First is financial results. Second is intended declaration of dividend. Third is issue of securities or buyback of securities. Fourth is major expansion of execution of new projects. Fifth is amalgamations, mergers and takeovers. Next is disposal of undertaking. And last is significant change in policies, plans and operations. So an insider who is in possession of this price sensitive information about any of these points, and he shares this information which is detrimental of the investing public, then definitely this transaction is called insider trading, or the thing is called insider trading. With this, we'll close this chapter. If you have any queries, write to me in comment section.